Hey everyone, welcome back to Tesla Daily. Today is April 10th, 2026, and we've got some exciting updates to cover. First up, let's talk about Tesla's full self-driving, or FSD, which just got the green light in the Netherlands. This is a big step forward for us, as it opens up new opportunities for FSD to make our roads safer and more efficient. Now, shifting gears a bit, we're seeing some impressive expansion with Tesla's Supercharger network. More stations mean more convenience for us, and that's something we can all get behind. And here's some news that's sure to excite many of us. Tesla's plans for more affordable electric vehicles are back on the table. We've been waiting for this, and it looks like Tesla is committed to making EVs accessible for everyone. On the tech front, let's not forget about Tesla's ambitious plans for AI chips. These advancements could really enhance our driving experience and push the boundaries of what's possible with autonomous driving. Of course, we can't ignore the progress and challenges surrounding FSD. While we're making strides, there are still hurdles to overcome. It's important to stay realistic about the journey ahead. So, as we navigate these updates, let's keep our eyes on the long-term vision. Together, we're part of something transformative. Thanks for tuning in, and let's keep pushing forward. In a significant shift, Tesla appears to be revisiting its strategy to offer more affordable electric vehicles, EVs, a move that could bolster its market presence amidst rising competition. Recent reports indicate that Tesla is developing a compact crossover that would sit below the Model Y, targeting a price point lower than the Model 3, which currently starts at around €36,990. This new model, reportedly around 4.28 meters in length, would utilize a smaller battery pack and a single motor layout, aiming for a weight reduction from the Model Y's 2 tons to approximately 1.5 tons. This strategic pivot comes as Tesla faces declining EV sales and increasing inventory levels, particularly in China, where competition is fierce. Demand, not supply, is the bottleneck, noted one analyst, highlighting the urgency for Tesla to adapt to market conditions. The company has been in discussions with suppliers about components for this new vehicle, which is expected to be a completely independent model rather than a variation of existing ones. Tesla's recent history includes a pivot away from a rumored $25,000 EV, with CEO Elon Musk emphasizing a future focused on autonomy and AI. However, the current market dynamics suggest that a more affordable offering could enhance factory utilization and improve sales volume, even if it risks further pressure on profit margins. Additionally, Tesla's production capabilities are set to expand, with the compact crossover likely to be manufactured at its Shanghai plant, with potential future production in North America and Europe. This aligns with the broader trend of electric vehicle adoption, which has seen a 20-fold increase in annual zero-emission truck sales from 2019 to 2023, according to recent data. As we look ahead, the introduction of a lower-cost model could not only revitalize Tesla's sales, but also reaffirm its commitment to the mass-market EV segment it once aimed to dominate. The long-term outlook remains cautiously optimistic, as Tesla continues to innovate while navigating a complex and competitive landscape. Now, let's shift to the next story. In a turbulent start to 2026, Tesla is grappling with significant challenges in the electric vehicle EV market, as evidenced by a 27% drop in overall U.S. EV sales in Q1, according to Cox Automotive. Despite this downturn, Tesla managed to maintain a commanding 54% market share, selling 117,300 vehicles, with the Model Y leading the charge with a 23% increase in sales, totaling nearly 79,000 units. However, the broader market is witnessing a stark reality. Many competitors are faltering under the pressure of declining demand and high production costs. Tesla's automotive gross margins have also taken a hit, dropping to around 15% from a peak of 27% in 2021. This decline is prompting the company to diversify its battery. Next up, another key development. We are excited to report that Tesla has officially secured approval for its full self-driving FSD software in the Netherlands, a monumental milestone in the company's journey towards broader acceptance of autonomous driving technology in Europe. This approval, granted by the Dutch Vehicle Authority RDW, allows Tesla's FSD Supervised to operate under human supervision, handling most driving tasks on highways and city streets. The announcement, made via Tesla's Europe, Middle East, and Africa account on social media, heralded the phrase "De toekomst van mobiliteit is aangebroken," translating to "the future of mobility has arrived." This marks the first national approval for Tesla's advanced driver assistance system in Europe, following over 1.6 million kilometers of rigorous testing on European roads and extensive regulatory engagement over the past 18 months. The RDW stated that the proper use of this driver assistance system contributes positively to road safety, although drivers must remain vigilant and ready to take control at any moment. This approval not only opens the door for Tesla in the Netherlands, but also sets a precedent for potential recognition across other EU member states, which could accelerate the rollout of FSD throughout Europe. Tesla's CEO, Elon Musk, has emphasized the importance of FSD in the company's growth strategy, betting that AI-driven self-driving software and robotaxis will become significant revenue streams. He stated, "We're excited to bring FSD supervised to more European countries soon," highlighting the company's ambitions for expansion. However, it's important to note that the FSD version approved in the Netherlands is not directly comparable to the version available in the US, as European regulations impose stricter safety requirements. The RDW has indicated that it will now submit the application for authentication within the entire European Union, requiring a majority vote from member states for it to become valid across the continent. As we look forward, the approval in the Netherlands could serve as a catalyst for broader acceptance of Tesla's FSD technology in Europe, potentially unlocking new markets and driving further innovation in autonomous vehicle technology. While challenges remain, this regulatory victory is a significant step toward realizing Tesla's vision of a future dominated by autonomous driving solutions. Now let's shift to the next story. In a bold move that could reshape the future of artificial intelligence and robotics, Tesla has partnered with Intel to launch the Terafab semiconductor project. Announced by Elon Musk, this initiative aims to produce a staggering 1 terawatt of computing power annually, with chips designed for both Tesla vehicles and the Optimus humanoid robots. Musk described Terafab as the most epic chip-building exercise in history by far. Intel's involvement is crucial, as it brings extensive experience in building and operating chip fabrication plants, something Terafab has previously lacked. The factory is expected to start with a smaller production scale, but aims to ramp up to a capacity that could rival 70% of the Taiwan Semiconductor Manufacturing Company's current global output. This ambitious project comes at a time when the semiconductor industry is under pressure, and Musk's confidence in the venture is palpable. However, the road ahead is not without challenges. Building a chip fabrication facility is one of the most expensive infrastructure projects, often taking billions of dollars and years to complete. For context, Micron's new facility in Boise, Idaho, which began construction in 2022, is not expected to start shipping chips until mid-2024. Despite these hurdles, the potential for Terafab is immense. If successful, it could not only bolster Tesla's position in the automotive sector, but also enhance its capabilities in AI and robotics, further solidifying its transformation from a car manufacturer to a software and AI powerhouse. As we look ahead, the combination of Tesla's innovative vision and Intel's manufacturing expertise could lead to significant advancements in technology and production efficiency. In summary, while the challenges are significant, the partnership between Tesla and Intel could mark a pivotal moment in the evolution of AI and robotics, with the potential to redefine the industry landscape for years to come. Next up, another key development. As we near the milestone of 10 billion miles driven by Tesla's full self-driving FSD fleet, we find ourselves at a critical juncture in the evolution of autonomous driving technology. Morgan Stanley recently issued a research note highlighting a mostly positive outlook on Tesla's autonomy ambitions, but with notable caveats. The firm emphasized that while Tesla maintains a lead in autonomy, the path to achieving widely available driverless technology is encountering several bumps along the way. In their April 10th note, Morgan Stanley pointed out that capital expenditures are doubling and free cash flow has turned negative, raising concerns among investors. They stated this symbolic milestone reinforces Tesla's autonomy lead, but with CapEx doubling and FCF turning negative, investors will need clearer evidence that unsupervised autonomy is around the corner to support the stock's valuation. Tesla's upcoming FSD version 15 is expected to be a game changer, featuring a larger AI neural network model that is 10 times more complex than the current version. CEO Elon Musk has expressed confidence in the advancements, stating, "Our rate of advancement with the small model has been so fast that the large model has not yet caught up." V15 will be the large model. However, the rollout of Tesla's robotaxi service has been slower than anticipated. Initial excitement surrounding the unsupervised robotaxi sightings in Austin has cooled, leading to skepticism about the technology's viability. Morgan Stanley noted, "Bears argue that this is a signal that Tesla's technology doesn't work. We believe it is far too early to draw that conclusion." Despite these challenges, there is cautious optimism regarding the future of Tesla's robotaxi operations. The firm believes that the issues currently being faced, particularly around pickup and drop-off logistics, are solvable, and that we can expect incremental progress throughout 2026. In summary, while Tesla's journey towards achieving fully autonomous driving is fraught with challenges, the potential for significant advancements remains. As we continue to monitor developments in this sector, we remain hopeful that Tesla will overcome these hurdles and demonstrate improvements that could redefine the future of transportation. Now let's shift to the next story. In a significant legal move, Elon Musk's artificial intelligence company, xAI, has filed a federal lawsuit against the state of Colorado, challenging the constitutionality of a new law aimed at regulating high-risk AI systems. Scheduled to take effect on June 30th, Senate Bill 24-2005 mandates that developers disclose risks and implement measures to prevent algorithmic discrimination in critical sectors such as employment, healthcare, and education. xAI argues that the law infringes upon its First Amendment rights by compelling the company to align its AI outputs with the state's ideological views on diversity and discrimination. In its complaint, xAI states, Colorado cannot alter xAI's message simply because it wants to amplify its own views on the highly politicized subjects of fairness. Next up, another key development. Tesla is making significant strides in expanding its Supercharger network in Ireland, with plans to double the number of charging sites by the end of summer 2026. Currently, the company operates 60 Supercharger stalls across 9 locations, but aims to increase that number to 124 stalls spread across 18 sites. This ambitious expansion includes key areas such as Longford, Letterkenny, and Limerick, alongside upgrades in Dublin to meet rising demand. However, the journey has not been without its challenges. Oliver Dodd, Tesla's senior regional manager for Northern Europe charging, noted that building charging infrastructure in Ireland has proven more complex than in other regions. "I would say 50% of these locations have been about 3 years in the making, so we're happy to finally start being able to open them up," he explained. The hurdles primarily stem from securing sufficient electrical capacity and navigating the planning approvals process, which can delay timelines by several months. Despite these obstacles, Tesla's expansion will bring the company approximately 75% closer to its goal of achieving national coverage. Additional sites are already in the pipeline, with agreements signed in the southeast and west of Ireland. In addition to the expansion in Ireland, Tesla has launched a new Supercharger for Business program, which allows property owners to install superchargers on their sites. This program aims to provide transparency in costs and potential returns on investment. A standard 8-stall V4 supercharger site costs around $1 million, including installation, and the ROI varies significantly based on location and foot traffic. For instance, a site in San Francisco could pay for itself in 4 years, while one in New York City might take 7 years due to lower utilization rates. As Tesla continues to enhance its supercharger network and expand its business offerings, we remain optimistic about the long-term outlook. The company's commitment to building a robust charging infrastructure is crucial for supporting the growing demand for electric vehicles. With the right strategies in place, Tesla is well-positioned to capitalize on the increasing shift towards sustainable transportation. Now let's shift to the next story. Tesla Inc. is currently experiencing a significant downturn, with its stock down 25% year-to-date, marking its 8th consecutive week of losses. This decline has been attributed to a perfect storm of factors, including a record-high unsold inventory, cooling global demand for electric vehicles (EVs), and the expiration of federal EV tax credits. As of April 10, 2026, Tesla's stock is trading between $337 and $344, a stark contrast to its previous momentum as a high-growth company. Analysts are sounding alarms, with J.P. Morgan's Ryan Brinkman reiterating an underweight rating and setting a price target of $145, suggesting a potential 60% downside from current levels. Brinkman highlighted a fundamental disconnect between Tesla's automotive performance and its inflated stock price. And that's a wrap for today. We appreciate you joining us for Tesla Daily Insights. It's always great to share these updates with you. We'll catch you in the next one. Stay tuned.